Hi guys, welcome to this Moneycontrol live stream. I'm Nandita Khemka. You're watching special coverage on the RBI policy. Of course, we are counting down to the RBI policy decision that comes out tomorrow 10 a.m. with the governor's speech. But in the run-up to that, what are the expectations? What are the growth and inflation forecasts that one should be expecting this time around from Governor Sanjay Malhotra? These are some of the things that we'll be watching out for to understand what really the expectation is this time around. Well, first of all, a 25 basis point rate cut is a given according to economists and market participants. This would be the third rate cut by the RBI. February was the first time they cut interest rates by 25 basis points, and April, and now June we are expecting a 25 basis point. But the real question is, could there be an outside chance of a jumbo 50 basis point rate cut? Let's pose that question to Latha Venkatesh, joining me right now. As always, Latha, great to have you. Every policy you come here and decode for us what to expect. Tell us. You've spoken with a lot of economists. 25 basis point given in the wake of the inflation trajectory that's heading lower. Outside chances of a 50 basis point, because SBI is expecting another 50 basis point.
See, in this poll, SBI is only one vote. So it's not as if I would give greater weightage. Largely, if 90% of our poll indicates that people are expecting a 25 basis, the market has factored in only 25 basis. I don't think. See, there is an argument for 50 basis because inflation is much lower than the Reserve Bank's own target or mandate, which is 4%. And although the RBI's CPI average forecast for the full year stands at 4, there is a very good chance that they are going to reduce it and reduce it rather sharply. The market's average is standing at 3.5. So you can make a very good argument that let us do 50 basis so that you give growth a genuine push. But my sense is the market at the moment has factored in only 25. A feeling which was reiterated or boosted by the GDP numbers coming strong. I mean, if growth is strong, then why do more?
That's true. But in terms of inflation forecast, a lot of economists are saying they could see a downward revision of 20 to 30 basis points. 50 basis points, do you think that will be too optimistic?
Well, it at the moment sounds optimistic. If you go by what will RBI take such a leap, all the way from 4 to 3.5. But if you take a poll of the economists, their average is standing at 3.5.
Okay.
Because now when the May numbers come out, it's going to be 3%. Or will it be June numbers? It's as low as that. So because the year ago number was very high, so the base effect is big. As well, there has been a fairly decent drop in cereals, pulses, vegetables prices, and now even the vegetable import duty has been cut from 20 to 10. So it wouldn't be unrealistic to make it 3.5. The only reason why the market is going with 20-30 basis points is because will the Reserve Bank take a giant leap?
Okay, but before we get in our experts, I want to ask you about the growth figures as well. For FY25, 6.5%. Last April policy, we saw the RBI revising growth downwards to 6.5%. Certain brokerages have revised it downwards further to 6.2. Do you think the RBI will tinker with it, or they will just keep it at 6.5? Because external challenges are there, right?
The people I spoke to think that the Reserve Bank is going to keep it at 6.5 and only refer to the challenges. The global piece is such a moving piece. Every day there could be a new Donald Trump tweet, or there could be a new acrimony between various groups in the US, or a new adjective addressed to China, that one doesn't know what to expect. But usually when there is uncertainty, there is less investment. Why would a CEO want to put money when you're not sure whether an imported product in the US is going to be cheaper, whether an exported product from India will not find markets abroad because tariffs have been driven higher by the US. When you don't know anything, investment falls. So there is a danger to growth. My own sense is that RBI will not alter the number, but will highlight risks to that number.
Sure. Last time around, there was an announcement towards gold loans, a proposal to tighten gold loan norms. Of course, government also came out and said that loans below 2 lakh rupees should be exempt from these rules. Anything that the governor may allude to when it comes to that, or do you think that will happen off the policy?
We will certainly ask him if it is not already announced in the main policy. See, all policies are accompanied by non-policy related announcements, and there is a good chance that the gold loan issues are clarified or proper rules are announced by the government, by the RBI. It's quite a possibility.
Okay, so that was the editor's take. Let's now get in some external experts to understand what they are expecting. Joining me right now is Aditi Nayar, Chief Economist and Head Research and Outreach, ICRA, and we also have Mahendra Kumar Jajoo, CIO, Fixed Income Mirae Asset Investment Managers. Great to have you guys on the show this afternoon. Starting with Aditi. Aditi, first and foremost, your basic expectations. Are you also tilting towards 25 basis points when it comes to the rate cut?
Yes, thank you so much. Definitely tomorrow what we're expecting is a 25 basis points rate cut given where we are with growth and inflation. Earlier, before the GDP data had been released for Q4, we did have the view that a 50 basis points rate cut may be possible if we have a flattish to a disappointing GDP growth number for Q4. But what turned out was that the GDP growth number for Q4 was actually much better than what we had penciled in, and a fairly solid uptick in sequential terms for the GVA. But also for the GDP because of the net indirect taxes adjustment. Now, given the fact that GDP growth turned out to be better than expected for Q4 and for FY25 as a whole, looking at where we are with the CPI inflation average and the monthly prints that we are expecting for the next few months, I think it may be better to go in for a baby steps approach with a 25 basis points rate cut tomorrow, and then the MPC still has the flexibility to be able to continue or adjust its policy decisions over the next few meetings.
Okay, Aditi, I'm coming to you with lots more questions on growth and inflation, but let me invite Mahendra Jajoo as well. Mr. Jajoo, what is your what is the market factored in? At the moment, what are yields telling you, both in terms of the expectation on June 6th, as well as the terminal repo rate?
Yes, so market is right now expecting a 25 basis points rate cut tomorrow, and factoring in further rate cuts. Market is right now working with a terminal repo rate of somewhere close to 5.5%, and that means that there's some steam left in the market for bonds to go. But we will get a more clear direction tomorrow after the RBI's policy announcement.
Okay, terminal rate of 5.5.
Yeah,
that's what you mentioned.
What
Aditi, would you concur with that? A terminal rate of 5.5%, or would you look at 5.25?
So I can't hear Mr. Jajoo very well, but here's my view. As of now, I believe that the tenure is building in a terminal rate of 5.5. However, our house view is that the terminal rate can go down to 5.25. We do see a third rate cut being possible from here out. So 3 tranches of 25 basis points each is our baseline. The incremental data on the CPI inflation that has come in over the last few weeks even, is only pointing to a slightly softer outturn for the CPI inflation trajectory going forward. Now, obviously, in a situation like this where we have an above normal monsoon being forecast, that comes with its own risks, particularly related to periods of concentrated high rainfall, which can be quite disruptive for perishable prices, particularly for things like vegetables. So that could definitely happen. But even then, right now, what we're building in is an average CPI inflation, which is just about 3.5%. Even with a vegetable price inflation shock, I don't think that the average is going to fall. It's not going to exceed 3.7% this year. And we have many prints which are looking like they're going to be sub 3.5%, and a few that look like they're going to be sub 3% as well. There will be an uptick toward the end of the fiscal year. That's going to be, as the base effect turns from being very favorable to being less favorable, the inflation trajectory will tick up. But for most of this year, we're looking at very, very benign prints. And therefore, I do think that we definitely can't rule out that final 25 basis points rate cut at this point in time.
Okay, Mr. Jajoo, you said that the market at the moment is working with the 5.5, but aren't the OIS rates occasionally factoring in likely 525 terminal rate?
No, so everybody is expecting a deeper than a 50 basis point rate cut from here, because like Aditi said, that inflation is expected to be closer to 3% than 4%, somewhere between 3/4, 3.5. growth has revived in the current quarter, but then the challenge on the growth is going to be ongoing, especially with the global environment. So if the inflation remains benign, it is possible that, and it is more very likely that we'll see more rate cuts. But I said that at this point, market is working with a 5.5. The other thing is that, once the liquidity becomes surplus in the system, then the operating rate in the market anyway goes down. So the 3-month T-bill, for example, is already at about 560. So market is already trading below the, even SDF rate. So for the market, the movement is faster. So OIS or the market operative rates will reflect the market's expectation. So the excess liquidity in the system will de facto anyway take rates, 25 to 50 basis points lower than where the RBI is.
Mr. Jajoo, so where do you expect 10-year yields to take support? They have cooled off 75 basis points or thereabouts in the last 6 months. Now, system liquidity has, of course, improved. There's been a bonanza in terms of RBI dividend as well. Do you expect yields to stabilize around the 6% level?
Yeah, I mean, we have had a period of close to 4-5 months where the 10-year was very, very sticky around 6.75% level. And now we have seen that the 10-year has been very sticky around 6.25% level for the past few weeks. So market will wait for further guidance from the Reserve Bank. At this point, all of us are expecting at least 5.5 and lower. If that is confirmed by the Reserve Bank's guidance tomorrow, then the 10-year will make the next move. We also need to observe that, the curve between 10 to 30-year or 40-year has steepened very significantly. So when the whole rate cut cycle started, the difference between 10-year and, say, for example, 40-year bond was just about 10-15 basis points. Now it has gotten closer to the 60 basis points. So at the longer end, we have not seen much action. On the other hand, we have seen a complete indifference and apathy from the pension funds and the insurance companies at the longer end. So while we are feeling so excited about 10-year, the opportunity now in the 30-40-year space, if the next phase of the rate cuts begin, will be much bigger in my view.
Okay. Mr. Jajoo, can you help the two of us with what we should watch out for in this speech?
Sorry, can you please repeat your question?
What part of the governor's speech will you watch out very closely? Because now the stance is not being put to vote. And in any case, the stance has become accommodative. So there is nothing to watch over there. What should we watch out for as clues for the next move?
So there are two important factors that we will be watching for. One is the confirmation and assurance on the rate cuts in the next policy. So tomorrow's rate cut followed up by assurances for the more rate cuts to follow, and then continued action on the OMO side, because OMOs are something which for now, given the higher already positive liquidity, market is somewhat building up a scenario of a slowdown in the pace of the OMO. So that's again something which market will want to take a clue from. And finally, I think if there is a comment or question on the steepness of the curve beyond 10-year, and if there is a positive or supportive response to that, I think that will be very helpful for the market.
Aditi, what about you? What would you be watching out for in terms of growth forecast, in terms of liquidity measures? Because as you were discussing, system liquidity is fairly comfortable now. Any tweaks that you would be watching out for when it comes to liquidity management as well?
So a couple of things, on the growth side, we're not expecting the MPC's forecast to be changed at this point in time. They may want to wait and watch and get a little bit more clarity how Q1 is going to pan out before they change their growth forecast. And on the inflation side, I think the main thing we're looking for is how much are they going to actually pare the inflation forecast, because we're quite a way off now from the last annual and set of quarterly forecasts that the MPC had released in April. And certainly, this time we're really going to be looking very carefully at the quarterly forecasts as well to kind of try and understand how the MPC is seeing the trajectory moving over the course of the year. So the extent of the cut, I think that is something that's going to be quite important. And that, in addition to the other overall, commentary on the uncertainties related to growth as well as to inflation, what do they see as the upside risks, if at all, to inflation? We'll be looking quite carefully at these signals to try and understand, after tomorrow, how much more of rate easing we should be building in. On the liquidity side, definitely we have seen liquidity being quite comfortable. At the same time, we did see particularly Government of India's capital expenditure kicking off very strongly in April. So I think incremental information on how much the government spending is going to be front loaded this year, that is also something that will have an impact on the liquidity situation. But obviously, that's not something we'll get any clues on tomorrow. So overall, just the kind of comments surrounding what level of liquidity surplus the RBI and the MPC are comfortable with. Certainly, this time around, we've seen transmission happening to deposit rates quite quickly because of the assurance that came through on liquidity over the last, several weeks. One more thing, that will broadly affect transmission going forward would be the small savings rates, on which we should, look forward to an announcement toward the end of this quarter, end of this month. So that is also something outside of the policy that will have an impact, particularly on transmission as well as on the overall CD ratio.
Aditi, what is your average inflation forecast for FY26? And what do you think the Reserve Bank may guide their forecast to?
Latha, we are tracking 3.5% right now as a baseline. And if I build in a vegetable price shock, that will take us to closer to 3.7%.
So what will RBI say?
My broad view is that tomorrow we'll get a 3.7% from the MPC. Because they'll want to kind of, be a little more conservative at this point in time instead of taking such a sharp reduction in the forecast.
You factored in the edible oil import duty cut?
Yeah.
Okay, in spite of it, you're saying that they may still stick with 3.7. Mr. Jajoo, how closely will you look at this number? Suppose instead of this 3.7, they say 3.5. How will the market react if it is 3.7? How will they react if it is 3.5, the inflation forecast?
So, Latha, we have seen over the last 1 year, the inflation number tends to be a bit volatile. So therefore, 1 year projection, we already know that the projection in the last policy is way out of the current number. So between the 3.5 and 3.7, obviously the market will feel happier with 3.5. But as long as it is, lowered down below 4%, I think market will take it very, very positively, because that means that there is headroom for more rate cuts, and there is next to zero risk of a sudden reversal in the RBI's stance. So I think between 3.5 to 3.7, 3.5 is obviously better, but I think market is more focused on the assurance of forthcoming rate cuts, and more from a 10-year yield point of view, some indication on the continuity of the open market operations.
Okay, no, that I agree with you. Whether they will continue to keep liquidity at 1% of NDTL is, I think, a big point that the market will watch out for.
Right.
Liquidity now, but will it continue? Is an assurance both of them are seeking, Aditi and Mr. Jajoo. Sure. But Mr. Jajoo, if it is at the moment, what has the market priced in terms of an inflation? If they say 3.5, do you think the market's repo rate expectation, terminal repo rate, will go to 5/4?
Yes, as I said that, if the terminal repo rate is 5.5, the market operative rate will anyway be below 5.5.
No, that I agree. That is a different matter. That is a liquidity issue. What I am asking is that if tomorrow the RBI says that we are reducing our average forecast of CPI from 4 to 3.5, do you think the OIS rates, etc., will start pricing in 5/4 as the terminal rate?
Yes, absolutely so, absolutely so. Because, if the inflation forecast is somewhere in the 3.5% vicinity, then we are looking at a real rate of 1.5%. Then also we are looking at somewhere close to 5%. So OIS will obviously move in anticipation, but I think with that forecast, even 10 years should try to hit 6% very quickly.
Aditi, anything outside all this that you will watch out for?
Sorry, was that for me?
Yes. For you, Aditi. Anything, what all would you watch out for?
Well, definitely, if there is any kind of commentary regarding tariffs or any of the other uncertainties, that is something that they may touch upon, and that would also perhaps guide whether they change the GDP forecast or not. So we would be looking out for that, given the fact that it is a very uncertain year. Also, maybe how they kind of are viewing the last set of GDP numbers that we got, in case there is anything that they're taking away positively or negatively out of that. That's also something that we'll be looking for tomorrow.
Okay, one question I have for Mr. Jajoo. In the context of the narrowing rate differentials or spreads between the US yields and Indian yields, how do you see foreign flows into the debt market evolving in the next 2-3 quarters? And what are your thoughts on the US yields? They are still elevated at 4.3%. Yeah.
Well, I think now there is increasingly global acceptance of the fact that in US there is a redefinition or resetting of the term structure. So the 10-year yield in US is going up because of the domestic factors which are somewhat disruptive to their own economy at the moment, at least. And for India, I think the macro fundamentals are just improving. So we have a very strong growth prospect. We have a very strong fiscal situation. For the first time in the recent times, the inflation is, on below 4% on a very sustainable basis, at least at this point it seems. So therefore, the differentials between US and India has been narrowing, and the inflection point was 200 basis points. When that was breached, I think there is increasing conviction that the two parameters or the two variables are now getting divergent because of the domestic policies. And there is another important change is that increasingly RBI is taking a very forward-looking, domestic-oriented approach, and increasingly the global factors are becoming less relevant for them. And to the extent that global environment becomes volatile, RBI takes the lead role in terms of ensuring that the domestic financial industry or services remain non-disrupted. So I think today somewhat of a disruption in global environment has become one of the factors why RBI will continue with the easing policy. And as I said, that the US 10-year yield is now clearly being differentiated from the Fed monetary policy. So Fed is still expected to cut rates by 50 basis points for the rest of the 2025. And therefore, whether the 10-year yield in US goes up further from here will not have that much of an impact on the FPI flows, because it's not just that the domestic people are now, getting indifferent to the 10-year yield. If you look at the global commentary from the largest and the most established names, all of them are talking about the term structure of the US yield curve being redefined.
Being steeper.
Latha ma'am, I want to get in your thoughts as well. The differential is narrowing 2%. Why would really foreign investors then invest in the Indian debt market? Even in April, the FPI outflows were quite sizable from the debt markets.
That is a very, very relevant question, because we have traditionally thought that if US yields, if our yields fall too close to the US yields, it is more attractive to go to the home market. But what we have to factor in now is, whenever that happened, then the rupee comes into danger, or Asian currencies come under threat when the interest rate differential narrows. But now what is under threat is the dollar. So there is an aversion to US bonds, not just because you don't know what the deficit will be. There will be a huge supply of paper because of the tax cuts and the increased fiscal deficit. More supply means obviously the price goes down and the yield goes up. But what the dollar will buy itself is now under question. It is likely to buy less and less. It's now at 98.5, the DXY, and versus the euro is 1.14 to the dollar. I mean, so the dollar is 1.14 to the euro. So the dollar is weakening against the G4 countries. There is therefore no threat at all, even if this differential comes down. It is the bond yield and the dollar, which are US bonds and dollar, which are weakening. And therefore, almost all Asian central banks are in a rate cutting mode and the cycle is not ending anytime soon. There is a huge disinflation expectation from the fact that, what we discussed even last time, if China can't push its goods and Vietnam can't push its goods to the US, they will be looking for a home in Asia. And that also will bring down inflation. When the dollar falls and the rupee appreciates, then the price of the incoming imports also is cheaper. A stronger rupee, appreciating rupee, or not weakening rupee also means a disinflationary factor. So inflation is such a set in a disinflationary mode for the next 12 months that interest rate differential is not at all going to matter.
Okay, so that's the thought. But let's get in Aditi's thoughts as well on this one. Aditi, what are your thoughts on where the US yields are headed, and what happens to FPI flows into debt market if the gap keeps narrowing or settles at 2% like how it is right now?
So, a couple of thoughts from my side. Firstly, we believe that right now 50 basis points of rate cuts are already factored into where the 10-year is. And if that final 25 basis points rate cut materializes that I was talking about earlier, I still don't think that the Indian 10-year is going to really fall below 6%. So I think 6% is probably where we're going to find a floor for the 10-year. And therefore, where the US 10-year moves going forward, depending on the Fed, when are they likely to cut, if at all, it will be back-ended. Possibly, we could see that the spread will narrow a little bit more from here on. But then as the US Fed rate cut expectations, if they rematerialize, then the spread may widen again after that. So that's broadly the kind of trajectory that we're expecting. And tomorrow, for instance, today my sound is not very clear, so this is what I'll just paraphrase what I understood from the earlier conversation that you were having. If tomorrow we end up getting the CPI inflation being cut to 3.5% in terms of the average for this year, I think that could make the bond yields come down materially tomorrow itself. But if it comes down to 3.7% tomorrow from the existing 4%, then it may take more time before we find that the market starts building in the final 25 basis points rate cut. So I think this is probably more likely to happen over the period of the next 2 to 3 months instead of happening immediately. So for the time being, the spread may remain, closer to where it is right now, and that is something that would then guide the FII flows. Otherwise, I completely agree with what Latha was saying. There are so many issues regarding the size of supply in the US itself. And, inflation differentials between the US and India have probably, I don't know when they've ever been this narrow. So that's also something that is going to lead to the current spreads being very, very materially different from what we've seen in the past.
The inflation differential is 1%.
Yeah.
We are at 3.5%, they are at
They're 2.5 almost, yeah.
Just a final question to you, Mr. Jajoo. What's the lowest you're expecting the 10-year to go to in India? Does it go below 6? I mean, it's
Well, as Aditi also said,
not a long way to 6, but does it go below 6?
yeah, I mean, as Aditi was also saying, that if you go by the historical valuations, then even considering a 5.25% repo rate, somewhere around 6.25 looks fairly valued. So in the momentum, it is possible that 10-year goes below 6%, but on a sustainable basis, we are already seeing a lot of resistance at around 6.25. So I think below 6 is a very big ask from the market for the time being. And as I said, if market gets more comfortable with the sustainability of the rate cuts, then it is more likely that the 10 to 40-year spreads will begin to narrow, because there has been a complete absence of buying from insurance and pension funds in that segment for the last 3 months. And if the 10-year gets closer to 6%, then I think that's where the next round of action should be, which is in the 30 to 40-year bond segment, because that still has a spread of almost 60 basis points. So 25 on 10-year plus 25 on 30-year is where I think the market will possibly begin to take some rest again.
Okay, thank you very much, Aditi and Mr. Jajoo. I just wanted to add, Nandita, that increasingly there are guests who come even on CNBC TV 18 and say that there is a reset in Indian macros. For the longest time, I mean, ever since I have been covering, like from mid-90s, India's current account deficit was always 2.5 to 3%. Now it is 0.5% or half to 1%. Inflation was for a very long time, in the high single digits, and then even in double digits from 2010 to 2014. But now we have come down from 6 to 5 to 4, and so 4 seems like a reasonably long-term settled average for the Indian inflation, or so it seems. I mean, it is not proven. It is 3.5 for this year. On this base of 3.5, whether we will be able to maintain, below 4. We may get to 4, but will we be able to keep it at 4 is still a little bit of a question. But there are a lot of people out there willing to believe that will happen. So there is a reset of Indian macros that people are beginning to believe in. And if that is the case, then all these interest rate differentials, etc., will not bother us anymore. The money will come simply because of the healthier macros.
Sure, and of course, we've already kind of overtaken Japan as the 4th largest economy, right? About to take Germany as well, take over Germany.
Large economies don't bother the bond market at all. They will only look at how much you are indebted.
There has been a reset, in terms of the Indian economy. And I just want to point out that the markets are also in fine fettle today, Latha ma'am. Almost a 200-point uptick on the Nifty in anticipation of a 25 basis point at least. If 50 comes, who knows, we may actually be able to break out of that range that we've been witnessing in the Indian market for quite some time now. 16, 17 sessions. We've not been able to cross
that 25,000.
25,500, yeah. So that's what, of course. So, but with that, I think we'll call it a day. Tomorrow will be the big day. 10 a.m. is when our RBI coverage will start. We'll also get in Latha ma'am to join us from the RBI headquarters for 10 minutes at least to understand her thoughts. And of course, you guys be with Moneycontrol. I'll be back with closing bell at 3:30 p.m. To see you with the markets. But till then, stay tuned and keep logging on to our website as well to get a sense of what's happening in the world over. But with that, thank you, Latha ma'am, for joining in as always. And thanks for watching to our guys. Come back and join us at 3:30 p.m.
Thanks for having me.